You're talking about how you expect volatility to rise and the market to broaden out. How much are those two ideas compatible?
Well, I think that's what we've seen happen, actually, since the beginning of July, both a broadening of the market, right? If you look at the equal weight S&P 500, it's outperformed, value stocks have outperformed, et cetera. So that's been the broadening. And then we've obviously had the rising volatility. And that's something we've been calling for a while now, because both of the phenomenons we've seen, extremely concentrated Mag 7 performance, combined with very low volatility, is absolutely abnormal.
Which to me is compelling, especially because you wrote this, our approach more technical than fundamental. How much is what we're seeing purely technical, overcrowded trades, unwinding of carry trades, versus fundamental weakness?
Yeah, so I think it's very much technical. Think about how we went into this. If you looked at June 30th, if you looked at a cap-weighted measure of momentum, it was in the 5th percentile over the last 12 months. That's extreme positioning. So we went into this with extreme positioning. And then a few things moved the market dramatically, right? I think part of it was the lack of liquidity that we see normally during a summer. You had the unwind of the yen carry trade. And the market has moved from, oh, this is great, the CPI is slowing, the Fed's going to cut, buy small cap value stocks, to, oh no, the Fed's behind the curve, buy min vol stocks and sell everything else. And that just doesn't make any sense. And when you look at the underlying fundamentals, yes, the economy's slowing, but in a good way, right? Through labor participation growing as opposed to layoffs. It's, if you look at the Fed Now measure, the Atlanta Fed, that looks pretty healthy. Earnings season's really good. So I think the underlying fundamentals are still very strong, and this is mostly technical.
So where does that leave us now? If we had this technical froth come off the top, you had credit spreads finally widen, you had the dollar yen did what it do, you had Japanese stocks selling off the most since 1987, and then a rally in the back half of the week. Right. So where do we stand in terms of stretched and frothy technicals?
Yeah, so I wouldn't be surprised if the volatility continues for a while, even through the fall, right? September and October tend to be volatile months. And then after that, I think as you get into the October earnings season and you see, oh, everything's still okay, I think that's when we'll see all this settle down.
Well, I know you say don't time the market, but in some way, should I see every time stocks drop like they did, do I need to lick my lips and say time to buy up?
Yeah, I do think when you get a decline of 10% or more, which happens, is not uncommon. I'd say once every other year you get that kind of event. That's typically been a buying opportunity. So yeah, I do lick my lips when I see that, and I do get excited.
You say in your note that you want to take this more discerning view of the market. This potentially can be a stock picker's dream, what we're seeing right now. What industries are you looking at?
Yeah, so when I think about stock picking, I think about skill and volatility, right? The more volatility, the more you can apply your skill and make money. And so I think there are a lot of interesting sectors right now. If you look historically at Fed rate cuts, one thing that always works, or has always worked, I should say, has been quality and low beta. And right now I see a lot of low beta stocks. They're actually pretty attractively priced. Healthcare, staples, even utilities.
Okay, so we have the Fed rate cut, but then after that it's going to be a U.S. election. Do you position differently for politics?
I don't think you can. I think you have to look, and yes, there are certain sectors that may be at risk if one person wins or the other person wins the presidency. But for the most part, I think what you want to do is avoid that kind of risk and just go straight up the middle.
When you start to look at some of these opportunities that benefit from rate cuts, how concerned are you that we've overpriced some of the potential depth of rate cuts, certainly this year and even next year?
Well, I think one of the nice things that the Fed has set up here is by raising rates to over 5%, you really create a lot of room to cut, right? And so I think the Fed now has a lot of cushion, and so we could get a number of cuts over time, and that's kind of what the market's expecting.
How much, though, does this really hinge on CPI? And this is a reason why we heard from Richardson that this is one of the most important moments going forward, simply because on one hand you've got growth concerns, on the other hand you have the Fed's inflation mandate. And if inflation doesn't cooperate, it really ties their hands with how much they can use that lever of cutting rates. How much, if we got a hotter than expected inflation read, not just this time but also over the next couple of months, how much would that shift your view? Yeah,
so I think that would definitely give the Fed pause. But remember, the Fed's going to look at both the economic data and the inflation data. And if you go back to 2007, right before the global financial crisis, in 2008, inflation was still really high. If you remember, oil peaked at 140 in June of 2008, and then the Fed was cutting despite that. Why? Because they were worried about the economy. So if the Fed got really worried about the economy, they'd cut even with inflation. They'd look at it as a lagging indicator, not a leading indicator. I don't think we're there.